Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
All right, today I welcome on the show, Tom Wheelwright. Tom, thanks for joining us.
Hey, thanks for having me, Jacob. It's absolutely fantastic to be on your show first time.
Yeah,
Great.
Absolutely. It's a pleasure for us, Tom. Well, Tom, can you tell the audience a little bit about yourself?
Sure, I'd be happy to. I actually grew up in Salt Lake City, Utah, heart of Mormonism. So as a result, I spent 2 years knocking on doors and having them slammed in my face in France. That was a great experience. If you've never had doors slammed in your face, I highly recommend it. I always think that the first lesson of entrepreneurship is how can you handle rejection? And let me tell you, when you get doors slammed in your face a couple of hundred times a day, you really get good at handling rejection. So anyway, from there, I went to the University of Utah, have a degree in accounting, a bachelor's degree in accounting from there. And then I went to the University of Texas at Austin, where I have a master's of accounting and tax degree. I spent my entire career doing tax. I spent 7 years with Ernst & Young, including one of the big accounting firms, including 3 in their national tax office. And interestingly enough, at least I think it's interesting, I was there the last time we had major tax reform. So that was 30 years ago when we had major tax reform. And what I did there primarily was, besides watching legislation, which we got to go up on the Hill and talk to congressmen and so forth, but what I did primarily was develop and teach courses for the CPAs around the country so they could help their clients reduce their taxes. My specialty was always real estate. So I spent a lot of time in the partnership real estate area. That was the group I was in. And then I spent 4 years as the in-house tax advisor for a Fortune 500 company here in Phoenix. And the reason they hired me actually was because they just bought a big real estate development company and they needed a real estate tax guy to advise them on their taxes. So that was my primary focus there. And then for the last almost 25 years, I started my firm. I started from scratch. So I actually didn't get enough of the rejection when I was a missionary, so I decided to do it again and start my own business. So, but the good news is man, I was persistent. I was so persistent. I actually had one new client, he said that he agreed to be my client just because he'd never actually seen an accountant do cold calling. And he was just so impressed that I would actually cold call. I don't recommend it, by the way. It is not the best way to attract clients.
Not the most scalable way.
But it's not. It's hard work. I'll tell you what, though. It was just a terrific lesson. And boy, if you can I did 9 months of cold calling. If you can do 9 months of cold calling, I think you can probably tackle any sales situation, particularly in the real estate area. I just think it was a great experience. I mean, now we're one of the top largest CPA firms in Arizona. We have clients in 50 states. We serve clients all over. We have clients in over 20 countries around the world. And again, we focus, our clients are focused on reducing their taxes, and our specialty is real estate.
Yeah, awesome. Well, Tom, you are certainly an authority in this space in today's day and age, and you really have a focus on real estate investing, as you mentioned. So could you talk about why real estate investors should not kind of fear tax? Because you have a really interesting perspective on tax, and you've got a way of making it very simple and almost fun, which seems like an oxymoron to most.
Wait a minute. Almost fun. No. The goal is fun, easy, and understandable, Jacob. But there's no almost anywhere in there. All right, so here's what you have to look at. You write down the word refund. Okay, right smack in the middle of that word is fun. So who doesn't want a refund, right? And if you're a real estate investor, you should not be paying tax on your income from your real estate, on your cash flow from your real estate. You should not be paying tax on your capital gains from your real estate, and you should never be worried about an audit. So those are the 3 things that should happen if you're a real estate investor. And if you're not, it's probably because you or your tax advisor you're not looking at taxes the right way. What most people fail to recognize is the tax law, while it does raise revenue, if not the primary purpose, is to direct the economy. And so it's just a series of incentives. And the incentives are lean heavily towards business owners and professional investors. And you can really see that if you paid any attention to this new tax bill. The new tax bill is a business tax bill. It's a business tax bill. It is not a bill to reduce individual taxes. It is a bill to reduce business taxes. And so its goal is big business and professional investors. That's who it's after. And the benefits in the new bill are fantastic, but the benefits for real estate generally are fantastic. So whether we're going to have the existing law or the new law, the tax law is just geared so heavily. And by the way, not just in the U.S., it's all over the world. I travel all over the world with a fellow by the name of Robert Kiyosaki that some people have probably heard of.
Some people.
Some people. Best-selling author in the world, a personal finance author. But he and I travel all over the world. Every year we cover the globe a couple of times at least. And it's interesting. The laws in every country are very heavily favored towards professional real estate investors. So it's not just the U.S. The U.S. has more tax benefits than most countries, and yet all countries have some.
Well, Tom,
and pretty good tax benefits.
Yeah, that's great, Tom. Well, Tom, can you tell us exactly how one can eliminate their taxes? Because you say that that might sound a bit skeptical.
Well, here's the thing, that I understand that you're taxed on your taxable income, right? You're not taxed on your cash flow. You're taxed on your taxable income. And taxable income is defined as income minus deductions. Well, there's a deduction in the tax law called depreciation. Chapter 7 of my book, Tax-Free Wealth, by the way, is all about depreciation. So if you really want to understand that, go to Chapter 7 of Tax-Free Wealth. In depreciation is a lot of people understand, a lot of people don't, okay? Actually, the very first time I ever spoke at one of Robert's events, I was actually a participant in the audience, and I haven't told this story very many times. And I just bought an accounting firm, and he was one of the clients. So I decided I better go to one of the seminars because I had no idea who this guy was. And I'm sitting in the audience, and he invites me up to explain depreciation. And I said, it's a little bit of magic because what you get is a deduction over a period of time as if the property were wearing out, whether it wears out or not. And this new tax bill actually gives us an even better deduction. So the deduction for, say, multifamily residential right now for just a building is about 3.5% a year. And that actually increases under the new tax bill for both residential and commercial properties. So, in fact, all of the depreciation benefits increase under both the House and the Senate bills that are coming up here for vote. So what happens is that you get to deduct. So let's say, for example, let me give you an example. Let's say that you buy a property for $1 million, okay, and you put down $300,000, or you and your investors put down $300,000. I know you talked about syndication, and the bank puts in $700,000. Well, you get a deduction, full purchase price over a period of time, less the land. I mean, land doesn't wear out. Even the government knows that. But
Right.
You get a deduction over time for whatever's not land. So say that it's $800,000. Well, okay, the bank put up most of that money. The bank gets no depreciation deduction. You get all the depreciation deduction. So when you add debt, you add leverage to your real estate, you're not just you're not just arbitrating, right, your cash on cash return. What you're doing is you're increasing your tax benefits sometimes 3 or 4-fold, okay? And by using that leverage, what you end up with is you can end up with positive cash flow and negative taxable income. Let's say that your positive cash flow on a typical $1 million bill, and I've run these numbers, by the way. I've taught this 100 times. If you had let's say you had $1 million, and let's say your cash flow after your debt service was $60,000. Well, your depreciation should be about $100,000 a year. So that means that you have cash flow of $60,000, but you've got a tax loss of $40,000. Well, if you have other income, let's say you have income, let's say your spouse has a job or you have a job or a business, and let's say you're making other income, let's say you're in a 40% tax bracket. Well, that $40,000 of loss can offset that other income, and at a 40% tax rate, it's worth $16,000 to you. Well, think about that. If you were to go out and buy a single-family home or a duplex or something, and you paid $80,000 for it, guess what? That $60,000 would be your down payment. So effectively what the government is doing is you buy $1 million multifamily project, they will go in and they will fund for free an $80,000 property.
Yeah, that's
great.
great.
That's the magic of depreciation.
Yeah, the magic of depreciation compounded with leverage.
Right.
Yeah. So
That's what it takes. It takes the two.
So, Tom, there's obviously a ton of benefits from a tax perspective for real estate investors. Now, with these pending changes from Senate and House, what kind of changes can one expect and what changes are coming?
Well, there are a couple of, I think, big changes, real estate, but it's all good. There's one thing that could be challenging for some developers, okay? So let me go over the good things. First of all, depreciation, we get even faster depreciation. So you want your money fast, you want it soon, so you get it even sooner, faster under both of these bills. So that's a plus. Okay. Second of all, the bills do change like-kind exchanges. Now, some people, most people know them as a 1031 exchange. That's the Internal Revenue Code section.
Right.
But this is where you can sell a property, okay, buy another property within a certain amount of time. As long as you don't handle the cash yourself, and you don't take any cash out, and you buy even or up. In other words, if you sell for $100,000, you got to buy at least $100,000 property. If you sell for $1 million, you got to be at least $1 million property. But if you do that, you don't pay any tax on that gain. Well, that rule is going away for anything except real estate. So real estate lobby is doing a good job. They're protecting their like-kind exchanges, which you might expect given the profession of our president. But nevertheless, they are absolutely protected. Now, the thing that a lot of people are not aware of is the carried interest rule. And we're not exactly sure how this is going to apply. But let me see if I can explain the carried interest rule, because for your investors who are for your listeners who are doing syndications, this is a big deal, okay? Because all of your income ought to be carried interest. Okay, except for your management fee that you take so that you can operate. All of your profits should be carried interest if you're the developer. So basically, here's the way carried interest works. Let's say that you go in and let's say you do a deal like my buddy Ken McElroy does. His deals are typically 75-25, which means that the general partner, which is MC Companies, takes 25%, and the investors get 75%. The investors putting up most or all of the money. Okay. And for their efforts, they get a management fee to take care of their monthly expenses. And then they get for operating the property. And then they get a back end of 25%. Well, that back end is not going to come out until they sell the property or refinance the property. Well, at the point that you sell the property, what have you really done? You've taken, as a developer, you put your hard work into developing that project. It's really services. And so logically, that should be ordinary income, tax at ordinary income rates. That's not what the tax law says. The tax law says right now that is capital gain. So even though you didn't put any money in, when you get the gain out, you get capital gain treatment. It looks like what the Senate is proposing, and I'm not sure whether this will apply to real estate or not. We'll have to wait to see what comes down. But what they're proposing is that you have to hold the project for 3 years. Now, for most real estate developers, that's not an issue. I know in the last couple of years that has been an issue because there have been a lot of real estate developers who have just hit it. You know, they just timed it right in this economy. We've got such low cap rates. And when you have such a hot market like we have right now in multifamily, then, you know, they might have turned a property that they normally thought they'd hold for 3 to 7 years. They might have turned it in under 3 years.
Yeah, right.
So that's something to look out for, because you ought to sit down with your tax advisor. If you're going to do development, in other words, you're going to go into a project, you're going to bring it up to standards, you're going to, put new tenants in it, et cetera. And you're going to take a piece of the action, not for money you put in, but for efforts you put in. You ought to sit down with your tax advisor and make sure that you get the carried interest rule to apply to you, because that's half the tax rate. Capital gains is half the rate of ordinary income. So it's a really big deal. So we'll have to watch the bills to see what happens with the carried interest rule. It was actually a campaign promise of both Donald Trump and Hillary Clinton that they would eliminate the carried interest. So I think that's why it's in there. And but we'll see what happens with that one. Those are really the only major real estate changes, those 3 things.
Yeah, okay. So some pretty positives on the horizon and then kind of one unknown, and we'll just have to see how that pans out.
Right, and certainly not a negative. And the reality is, if you're doing enough real estate, you should never be paying tax anyway, because even with the carried interest and your management fees, your losses from your real estate, from the depreciation, should offset that.
Yeah. Well, Tom, let's kind of switch gears here and talk about some of the mindset around paying taxes. Sometimes people fear earning more because of the sake of having to pay taxes. And I've heard you say in the past, don't let the tax tail wag the dog.
Well, first thing is, the tax law is there to benefit you, not to penalize you, primarily. There to benefit you, not penalize you, particularly as a real estate investor. Second of all, remember that these are not loopholes that you're taking advantage of. These are intentional incentives to invest in real estate. So you're taking advantage, you're doing something the government wants you to do. The reality is that we are all partners with the government. Like it or not, we are partners with the government. If you're an employee earning a good salary, you're partners with the government to the extent of they will take 40% of your income. Now, you may not get much back from that if you're a W-2 employee, okay? On the other hand, if you're a professional investor, the government might be subsidizing your investment to the tune of 40%, okay? So you get tax breaks that you would not get if you weren't an investor. So the government's actually being a good partner. So the key is really to become a better partner with the government, make the government a better partner with you. We're all partners with the government. I mean, they're taking a portion of our earnings, and that is the definition. They get a portion of our net income. That is the definition of a partner. And so we want them to be a better partner. The other thing to recognize, and this is what I would suggest everybody write down. Here's what we're going to do, Jacob. I want you to repeat after me, okay?
Okay.
You ready? Okay. I will never speak to the IRS.
The IRS.
There you go. That should be your mantra. Don't ever worry about the IRS. Your tax advisor should be worrying about the IRS. Now, if you have a tax advisor that gives you advice like, if you want to pay less tax, you need to make less money. You need to say, the next words out of your mouth should be goodbye, because that is the most ridiculous thing I've ever heard. Our top tax rate is 40%. Even if you're in California, your top tax rate is 60%. So you still have 40% left. So shouldn't you be focusing on making money first? Okay,
Yes.
This is where I don't want the tax tail wagging the dog. You want to focus on making money first. Just recognize that the tax tail is a pretty big tail. And what you'd really like to be more like a Cocker Spaniel, where you get that tax tail bobbed, right? And there's very little of it. And that's the benefit of a real estate investor that is an active professional real estate investor, is they can actually bob that tail down to practically nothing. And in some cases, absolutely zero. I do have clients that pay zero tax that are real estate investors. It just takes a lot of real estate to do that. And you can make millions of dollars in cash flow and still pay zero tax. It is entirely legal. And in fact, it is intended, and the government loves it. So, the key is, if your tax advisor is, another thing I would say, if your tax advisor is telling you don't take a deduction, like don't take a home office deduction, that will raise a red flag. What that should be telling you is that your tax advisor is afraid of the IRS. The last thing in the world you want is a tax advisor who's afraid of the IRS. Just remember, think about if you're in, let's say you're in a graduate school and you're getting a tax specialty in a master's of tax. And you're deciding, where should I go to work when I get out of school? And you go, well, I could go work for one of the big four, and I could work with big companies and get a lot of good experience there. I could go work with a smaller CPA firm and work with entrepreneurs and help them, be the hero and help them pay less tax. I could work with an industry, and I could help a company like I did for a few years, and I could help the company pay less tax. Then I'm a hero there. Or, wait, no, I could go work for the IRS. I could actually go to a company, what's called the IRS company, that my customers hate me. My customers don't want to see me. I am the last person in the world they want to talk to. If I say I'm here to help you, they scoff and laugh at me. Is that really where I want to go? And the answer, of course, is no.
Probably
so
not.
What happens is the best and the brightest do not go to the IRS, okay? You're talking about your C students here. And sometimes I'm afraid to say your C minus or D students. If that's the case and your tax advisor is afraid of the IRS, what does that make your tax advisor?
Oh, I don't know how they got the degree.
You go, what in the world? Yeah, what's going on here? And so, I look at an IRS, I actually don't mind them at all. They're kind of fun in ways. I'm not suggesting anybody should want one, but it's playing with the JV, right? I get to play against the JV. It's the varsity playing against the JV. It's just not that difficult. Now, sometimes they're a little befuddled. They don't understand things, and they kind of pound the sand, put a stake in the sand, say, okay, or a line in the sand, don't cross this line. And, well, there are ways to deal with that, okay? But if you've got a good tax advisor, who, by the way, always needs to be the same as your tax preparer, don't ever get a tax advisor who's different from your tax preparer, because tax preparation, by the way, can make a huge difference on your tax return. I'll give you an example. I had a client just the other day that I was looking, he's a new client to me, and I handle a few clients personally, and this is one. And I'm looking at his tax return. I'm going, I think you pay too much tax here. And he goes, how so? And so I explained it to him. He said, let me get my accountant on the line, which I thought was pretty interesting. So I got his old tax preparer on the line. And so I said, look, this is what I think you could do. And she goes, well, is this true? She goes, the client, is this true? This your situation. And I'm thinking, wait a minute, how did you not ask that question before? So they ended up amending the return. I mean, I think they got back like $50,000 in taxes.
Oh, wow.
Just because it was just a way I looked at the tax return differently than she did. That's all it was. And I asked different questions. So that's why you really have to make sure your tax preparer is a really good tax preparer. And then you don't ever worry about paying too much tax or, being afraid of an IRS audit or anything like that. You'll be ready.
Yeah, right, Tom. Well, Tom, there are people out there who are looking to get started investing in real estate and trying to figure out how to manage their personal W-2 income. And they come to this fork in the road sometimes. And I know this is a question you get frequently, is why I'm asking you, but they're looking at how much should they contribute to their 401k, or should they contribute to their 401k? Could you talk about whether one should postpone their income or go ahead and not contribute to their 401k and invest that income?
Well, some of it's opinion and some of it is just running the numbers. I think it depends on how much time you're willing to spend with your investments. If you want to just turn it over to somebody and not pay attention to it, you should put all your money into your 401k. You absolutely should, because diversifying in a well-diversified portfolio of mutual funds is probably your best bet for not losing your nest egg. That's the whole point of diversification, is to not lose money. I took that class in college. Okay, the reasons that you diversify, by definition, is to not lose money. It's not to make money, it's to not lose money. So if you're not going to pay attention, your best bet is to not lose money. So that's what you do. If, on the other hand, what you're trying to accomplish is you're trying to maximize your returns, that's a whole different, and you're willing to spend some time at it, that's a whole different world. Because instead of investing retail, which is what you're doing if you're investing in the stock market or a real estate investment trust, that's retail investing. You can invest wholesale. You can invest with another developer, if you're an accredited investor, or you can do it yourself and really invest at the manufacturing level. I mean, if you think about it, let's say you go buy something at Target, okay? Let's say you go buy clothes at Target. You're paying 4 times what it cost the manufacturer to make those clothes. So the manufacturer made them, then they sell them to a wholesaler, and the wholesaler then doubled the price and sold them to a retailer, and the retailer doubled the price and sold them to you. And that is standard. That's retail 101. Okay, my dad was in retail, and I'm telling you, that is retail 101. The same thing's true in investing. So if you think about an investment and you go, okay, if I invest in the stock market, what's the best I can hope to get? 7 to 10%. That would be max that I'm going to get over a long period of time, 7 to 10%. So if I invest wholesale, that means I can double that. So I should be able to get 14 to 20%. Okay, so if I'm investing with somebody else and they're doing all the work, but it's basically a wholesale transaction, then I'm going to get 14 to 20%. On the other hand, if I do it myself, I'm going to double it again. So I should be able to get 28 to 40%. And the other side of that is if I'm investing myself, that 28 to 40% is likely to be tax-free. Whereas if I'm investing at a retail, it's never tax-free. Let's say it's a 401k. That's not tax-free. That's tax-deferred. That's like when you're a kid. That's like eating your vegetables last and hope there's an earthquake and you won't have to eat them. We all know that you're going to eat those vegetables. But they're not going to taste very good because they're going to be cold. And the same thing is true when you put that money aside. You go, oh, but I get a tax benefit now. Yeah, but when you pull it out, you're going to pay more tax than the tax benefit you got putting it in. And if you question that, then I've got to say that your plan, the only way you pay less when you pull it out than the benefit that you have putting it in is if you plan to retire poor. And I've never yet met anybody whose goal was to retire poor. And yet, what do the financial advisors tell you all the time? Well, how much do you need when you retire? And, you're going to have fewer expenses, so you don't need as much money. I'm going, who cares what I need? What do I want? I mean, do you really want to be poor when you retire? Don't you want to have more expenses when you retire? I want to have more. I don't have less. I want to have more. I want to golf at better golf courses. I want to travel first class. I want to stay in better hotels. I want to do more traveling. I want to have more expenses. I don't have less expenses just because my house is paid off, or maybe I'm really lucky and my kids have moved out, then I'm not going to have those expenses, but I'm going to have other expenses. I'm going to have medical bills, okay? And by the way, under the house plan, medical expenses are no longer deductible at all. So, you got to look at this and say, what do I really want? And if your goal is to retire poor, then fine, defer away. That's what we call it, deferral. We're postponing or deferring our tax to a later year. But if you want to completely avoid taxes, there's like 6,000 pages of the tax law. Okay, not counting regulations and cases and rulings and so forth. There's like 6,000 pages of actually tax law. There's 400 pages that talk about how to defer taxes. At least 5,600 pages that tell you how to permanently reduce your taxes. So why would you waste your time on the 400 pages when you've got 5,600 pages of permanently, never do I ever have to pay this tax back ever again situation? Okay, so the only reason you would do that is, again, because you're not interested in taking the time. If you're willing to take the time and you're willing to put in the effort to invest in yourself, you're going to learn things like listening to the show, taking classes, etc. If you're willing to do that, okay, then there's, and anybody who understands investing, nobody who understands investing would ever be putting their money in a 401k plan. Unless there's one exception, and that is that they were going to trade stocks. That's what they were going to do. And then what they do is they put it into a Roth 401k plan, and they never pay tax on it, and they would trade stocks forever in a Roth 401k. Now, what you are never going to do, and I want to make this clear to all the listeners out there, do not ever buy real estate that you're going to, you're doing your own investing. Do not ever buy that in an IRA. Please do not ever do that. That is such a huge mistake. You lose all sorts of tax benefits. You lose the benefits of leverage. You actually have huge risks of tax penalties if you do it. So, just don't do that. I mean, pull the money out. If you're thinking about investing in real estate and the money that you have is in your IRA, your 401k, pull it out, pay the tax, pay the penalty. I mean, the reality is you owe the tax anyway. So that's not an additional cost. Okay, it's just a 10% penalty that's the cost. So if that's where your money is and you invest that money and you decide, look, I want to do investing in real estate, and that's really what you want to do. Okay, now do all your homework first before you're pulling money out. But if you decide that you want to invest in real estate, then just don't bite the bullet. Don't be thinking that I'm going to roll this into a self-directed IRA and do that garbage. That's just a bad idea.
Yeah, that is an interesting perspective, Tom, that tax is something you're going to have to pay now or later. So it's not really an expense to pull that money out now. You're just paying that penalty as the cost of doing business in the short term.
Right. It's a liability. So if you have $100,000 and you're going to pay 40%, you have a $40,000 liability. Your net worth in that IRA is $60,000. That's an accounting perspective. Okay. And so it doesn't matter whether you pay that $40,000 now or later, you still only have $60,000. What's worse is, as that $100,000 grows, so does the tax bill. And what's even worse than that is, we were just talking about, you should never be paying in tax on your real estate, either your cash flow or your capital gains, but you will if you do it in an IRA. You'll pay ordinary income tax on it. Okay, so why would you ever do that? Even think about stocks, okay? If I were stock trading, I wouldn't stock trade in a regular IRA. I would do it in a Roth so that I'm not taxable. But in a regular IRA, think about stocks. Even stocks, if I were investing in stocks, if you were to invest in stocks outside of an IRA, that's capital gains tax. You're taxed at 15%. If you do it inside of an IRA and then pull the money out later when you retire, that's ordinary income. So you've just taken 15% income and turned it into 35% income. Now, how that is a good plan, I don't understand.
Not the way you want to go.
Not the way I want to go.
Yeah, well, Tom, there's certainly a lot of information here for our audience to digest. What are some actionable tips you could give to those audience members who are just getting started investing in real estate or looking to maybe buy their first property in the next year?
Well, okay, number one, get education. Before you do anything, get education. If you were a stock trader, you would paper trade. In other words, you would pretend to trade for at least a year, maybe two, before you ever bought a property. I never see real estate investors do that. They just go buy property. It's so stupid. Find a property. In fact, find 10 properties and pretend you bought them. In other words, look at 10 properties that are for sale. Buy them on paper, okay? Record that you bought them, all right? And then look at, okay, what could you rent them for? Look at what the expenses probably will be and see how that shakes out for the next, what that's going to look like, and then see what happens to the price in the next couple of years. And you'll be able to track it just like you can stock trading. So I would get a lot of education first. Number two is I would make sure I build a really good team around me. Okay, I'd make sure that I had everybody I could think of on my team. And by the way, there's a really good book out. I'm a little prejudiced because I wrote a couple of chapters in it called More Important Than Money, which is a Rich Dad Advisor book. And it's all about building your team. So I highly recommend that book. And then the third thing is remember that the person who's going to have the greatest impact on your wealth, other than your spouse, is going to be your tax advisor. So be very careful about who you take advice from in the tax area. By the way, if the listeners would like to go to taxfreewealthadvisor.com, they can get a free copy of chapter 23 of my book, Tax-Free Wealth, and that chapter is how to find a good tax advisor. So I don't need you to come to me. If you want to, that's fine, but I want you to find a good tax advisor. That's a very critical position. So the one other thing I would suggest is develop a real plan of action. You said what are some steps? Well, number one step is develop a plan of action, develop a strategy for investing. I found over the years that there's a big difference between professional investors and amateur investors. And the difference is that amateur investors make a new decision every time an investment comes up. Every time they're making it, should I invest in this or should I not? It doesn't matter if it's stocks, real estate, they're looking all the time. They're like what we call it, squirreling, right? They're always squirreling.
Yeah, right.
And they're always looking at something, the bright, shiny object. Well, don't do that. Professional investors make a decision once. They make one decision. They just apply that decision over and over and over and over again. I don't care if it's Donald Trump, Warren Buffett, Bill Gates, Steve Jobs, they all did it the same way. They were very focused. They did one thing. They made one decision, and they did it over and over and over again. To me, that's the most important thing you can do.
Yeah. Very good point, Tom. It's kind of like having these systems and processes in place so they make the decisions for you.
You can only have those if you've already made the decision first. Okay, you can't put any systems in place until you've made your decision about how you want to invest. So are you going to invest in single family, multifamily? You can invest in small multifamily. You can invest in big multifamily. You can invest in Class A properties, Class B properties, Class C properties. Are you going to leverage? Are you going to not leverage? What kind of leverage are you going to get? What kind of interest rate are you looking for? What kind of rents are you looking for? Are you going to get cash flow? Are you going to get how much positive cash flow are you looking for? It's not just as much as I can. Okay, you're looking for a target number. Okay, am I going to refinance? At what point do I refinance? All of these are questions that you ought to be putting into your strategy. If it's a single-family home, is it a 3-2? Is it a 4-2? Is it a condo? Is it a 2-2? Is it a 1-1? What am I looking for? If it's multifamily, what kind of mix do I want in my multifamily housing? Do I want a 20% threes and 70% twos and 10% ones, or what is it I want? Okay, one bedrooms, what do I want? So make those decisions ahead of time, and then go find the properties, and they'll come to you. You'll actually find them. And actually, once you get really focused, the properties will just show up.
Yeah, all really good points, Tom. You've got to have a kind of a strategy, a vision in place, and some criteria of things you're looking for.
That's right.
Well, Tom, you're no stranger to helping real estate investors out with things like this. In fact, you and your firm Provision have been helping real estate investors for over 30 years now. So what are some things that you and your staff at Provision help real estate investors get sorted out?
Well, we really do basically three things. That's all we do. We're very, very focused on what we do. We do wealth strategy, which is what I just talked about. We actually help clients focus because we find that most people are so scattered that they need a professional to help them focus. And so we help them develop that plan of action for building their wealth. Number two is we help them reduce their taxes. We develop a tax strategy. So we develop a wealth strategy. We help them develop a tax strategy. And then third, we actually do everything else in the tax world. So we'll prepare their tax returns. We'll send them before the IRS. We will analyze their tax returns with them. Whatever they need tax-wise, we'll help do. And frankly, anything else we can help them with, business or investing, we're happy to help. We actually don't manage money. We are purely a service organization. So we do a lot of education. One of the things that makes us different is that we actually require our clients to get educated. It's not even an option. They have to get educated. So if you don't want to get educated, we're not a good fit. But if you want to get educated, we're probably the only fit.
Yeah, awesome. Well, Tom, as we're wrapping up here, do you have any parting piece of advice you'd like to leave with our audience?
I would just say don't shortcut. Okay, don't shortcut your entities, your LLC, et cetera. Don't go to LegalZoom, someplace like that. Don't shortcut. Get good professional advice. I'm not saying that because I need your business, because frankly, I don't really need your business. We have tons of people knocking on our door. What I'm really saying is that my experience is that people who get good professional advice and follow that advice are always going to win over people who tend to do it themselves. So put that team together. When you're planning your finances for investing, make sure you set aside money for the asset you call your team. Okay? Don't think, well, I'm just going to go cheap on that. That is the biggest mistake I see, is that people go cheap on their team members. And, nobody likes a cheap team member. So you're going to attract the level of people, a level person that you're that level. So if you're not willing to take advice, if you're not willing to listen and learn, then you're going to attract people that aren't going to give you advice.
Yeah.
So that would be my number one thing that I see. That's actually the biggest mistake I see with new investors is they tend to, try to bootstrap it, and they don't set aside money for their advisors and their team members. They don't set aside money for their legal team. That's a big mistake. And they're so anxious to get started that they don't take the time to actually develop that strategy.
Yeah, really good points, Tom. Well, Tom, you've given us a lot to think about here around eliminating one's taxes and not just postponing them, and how to develop this strategy around your real estate investing journey and career ahead of you. Tom, where can our audience find more about you and contact you if they have any other questions?
So website is taxfreewealthadvisor.com, taxfreewealthadvisor.com. Phone number is 866-467-5809. 866-467-5809, 866-467-5809. And book is Tax Free Wealth. It's on Amazon. It's on Audible. The only downside to Audible is you do have to listen to my voice for about 15 minutes hold, that it's really good on Audible, so I gotta recommend it. And it's also in Spanish.
Oh, awesome.
So if any of you speak Spanish, it translates out of the country. So don't feel like if you're listening to this from another country, somehow you got in contact with Jacob and you're in another country, that's okay. Taxes are pretty much the same around the world. So, however we can help, we're happy to. Education is the way we help best.
Yeah, awesome, Tom. We'll link all those books and your contact information in the show notes. Tom, we thank you for coming on the show today.
Thank you.
All right, take care, Tom.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.